Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's #2 economy. My name is Tony. Let's jump in. Today's video was brought to you by Masterworks. Keep watching to see how China Update viewers can skip the waitlist for some of the most popular pieces. Okay, happy Monday everybody. Today we have very mixed news, but let's start with the positive. With China well into zero COVID easing, the market is showing signs of optimism towards the PRC economy, or at least less pessimism than before. China's 180 on the property sector, as we have explored in Saturday's episode, has also increased confidence that the speculation party could still be on for a few more years after all. As we can see here, iron ore has risen to its highest level in almost 4 months. Futures advanced in Singapore, extending gains to almost 50% since a 45-month low at the end of October. Iron ore is a steel-making ingredient, the price of which has long been tied to the fortunes of China's real estate industry. The property sector accounts for almost 40% of China's steel consumption. We remember that in the upcoming Central Economic Work Conference, investors are speculating that Beijing may drop the phrase "housing is for living in, not for speculation," signaling that regulators will very much tolerate the latter once again. For example, in a note over the weekend, Citigroup Inc. told clients that there's scope for iron ore to rally further due to positive sentiment on China's shift away from zero COVID and government support for the property sector. Citigroup has increased its 3-month forecast to $120 a ton, with a $150 a ton estimate in the event of smooth reopening and strong government support for property. We will see how things unfold. With opening up underway, we may also be seeing the beginning of the anticipated short-term release of pent-up demand, especially in one of the sectors most badly hurt by zero COVID, the tourism industry. Within 24 hours of the publication of the most recent easing measures, the so-called 10-point plan released by the State Council last Wednesday, stocks in travel companies jumped. Several firms, like Guilin Tourism Corp, saw shares surge to the daily limit of 10%. According to data provided over the weekend by major domestic online travel platform Qunar, Qunar, searches for air and train tickets saw 7-fold and 5-fold jumps respectively within hours of the State Council announcement. These, of course, are positive signs, but analysts caution that household income has been badly damaged in the COVID era, and while we will likely see a temporary surge in pent-up demand, it will be just that, temporary. It could be some time before businesses see household spending return to 2019 levels. There is also a chance that this increase in travel and spending interest is premature, as the next month will likely see a massive wave of COVID infections wash across the country, a country with almost zero herd immunity. Indeed, as we will explore shortly, China's hospital system is already under tremendous strain. Next up, in interviews with UK-based Japanese-owned Financial Times, Japanese technology executives have warned policymakers in Tokyo and Washington that recent technology restrictions are unlikely to suppress China's progress in artificial intelligence and supercomputers. In interviews with the UK-based Japanese-owned Financial Times, Japanese technology executives have warned policymakers in Tokyo and Washington that recent technology restrictions are unlikely to suppress China's progress in artificial intelligence and supercomputers. The Financial Times writes that the warnings from Sony's chief technology officer and NEC's chief executive come as Washington tries to convince the Netherlands and Japan, both big players in the global chip-making industry, to strike a trilateral deal that would impose further restrictions on China obtaining tools to make semiconductors. Now, of course, as technology executives for companies that sell products to China, these views are coming from a biased position. Nevertheless, it's worth briefly examining the comments. In an interview with the Financial Times, Sony technology head Hiroaki Kitano said he expected the US-led sanctions to temporarily impact China's ability to procure semiconductors, but added that it was entirely possible that its global presence in AI would continue to increase. arguing that, quote, "The driving force of AI development in China is that they have access to very large data sets." End quote. NEC Chief Executive Takayuki Morita also expressed similar views, telling the Financial Times, quote, "Personally, I feel that while it may be possible for the US-China technology dispute over chips to slow down China's technology progress, the overall trend will not change. It's not possible to ignore China's competitiveness in technology, and it will become one of the forces to reckon with in the long term." End quote. Now we have one final story while we're on the economy. But first, currently with so much uncertainty in the world and global markets, sound diversification into alternative asset classes is as important as ever. And one particularly attractive asset class is artwork. Indeed, according to ArtPiece, the value of blue chip art has outpaced the S&P 500 by 180% from 2000 through 2018, outperforming most fund managers. In the past, however, investing in artwork was limited to the super wealthy. But today's video sponsor, Masterworks, is changing that. This isn't NFTs or crypto. This is Picasso and Monet. Masterworks has over 590,000 users and over $650 million in securitized art. In this year alone, Masterworks saw 7 exits ranging from 9% to 36% net returns. So, if you would like to skip the waitlist for some of the most popular pieces, click the link in the description below. Signing up is super easy. It took me less than 60 seconds. We remember that all investment involves risk. Always speak to an investment professional if need be before making any major investment. A big thank you to Masterworks for sponsoring this episode of China Update. Next up, during his official trip to Saudi Arabia, which we covered in Saturday's video, General Secretary Xi Jinping expressed that China would work with Gulf nations to start Yuan settlements of oil and gas trades in the next 3 to 5 years. Speaking at the China Gulf Cooperation Council Summit in the Saudi capital on Friday, Xi Jinping said that the Shanghai Petroleum and Natural Gas Exchange would be utilized to facilitate the trades in RMB. While the US dollar is overwhelmingly the currency of choice for oil settlements, the yuan has been making modest inroads on this front over the last several years. Iran has been accepting payment from China for its oil in yuan since 2012, and with Western sanctions, Russian natural gas supplies this year have been settled in the Chinese and Russian currencies. Even some Indian companies this year have used the RMB to buy Chinese coal. However, even Chinese experts admit that settling Saudi oil trade in yuan is still some ways away. Quote, "The petrodollar system doesn't only mean settling oil sales in the US dollar, but also using the US dollar in the international pricing of oil barrels, for which another currency won't easily be able to replace." End quote. There is also the question of what's in it for Saudi Arabia to consider. Saudi Arabia has long been the largest crude oil supplier to China, accounting for 17.1% of China's total 253 million tons of crude oil imports in the first half of 2022. Saudi Arabia could be looking to diversify its economic and trade partnerships and move closer to China. On the other hand, Saudi decision-makers need to consider American reactions. After all, the petrodollar has other interests and security implications between the US and Saudi Arabia. And of course, there is the matter of how Saudi Arabia and other Gulf states feel about the Chinese currency itself. Okay, finally for today's video, as China dismantles zero-COVID policy and begins opening up, experts warn of the massive strain a wave of cases will have on the country's healthcare system. Indeed, Chinese financial media outlet Caixin published a special piece over the weekend reporting that China's hospitals are already feeling the first shock and warning that the situation is going to become much more dire. Caixin writes that in cities such as Guangzhou and Beijing, the capital, that have taken the lead in implementing the new easing policies, fever clinics are full of patients and cross-infections between patients and doctors have begun to emerge. We remember that government experts have predicted a peak of infections in the next 1 to 3 months, with about 60% of the population infected, or approximately 840 million people. According to Zhang Wenhong, a prominent infectious disease expert in Shanghai. Among infected people, 99.5% may not need to go to the hospital, but the healthcare system must, quote, ensure that the remaining 0.5% can get hospital treatment, end quote. Based on that 840 million person number, over 4 million people will require hospital care in the next 1 to 3 months, if Zhang's view is accurate. This is also assuming no serious mutations that increase the number of people who need intensive care. Cai Xin and others report that hospitals in many hotspots are already overwhelmed, however. Quote, a doctor at a Beijing hospital said about 20% of the hospital's doctors were off duty due to their own infections or close contact with infected patients, leaving the rest of staff a heavier workload. A doctor at a Guangzhou hospital said the hospital is severely understaffed as more than 200 people have been dispatched to makeshift quarantine hospitals. End quote. Many hospitals in Beijing are already suspending receiving non-COVID related patients, with persons waiting cancer treatment being told that they need to wait. Chinese financial media outlet Yicai wrote today that a patient in the northeastern city of Harbin who needs dialysis every other day has not received the treatment for well over a week because, quote, all the nurses in the dialysis department are under quarantine as positive cases were found. End quote. Cai Xin analysts warn that despite almost 3 years of preparation time, China still suffers from a serious shortage of medical resources. One respiratory expert at Peking University's First Hospital explained to the outlet that the vast majority of COVID patients have mild symptoms, but given the massive numbers in China, there will likely be a high number of severe cases, resulting in a serious shortage of medical resources. When Cai Xin reporters called hospitals in Beijing and Wuhan late last week, several said that outpatient clinics were temporarily closed because they had received too many positive patients. As we have explored in previous videos, China also suffers from a lack of ICU beds. A 2020 study by the OECD showed that China had 3.6 ICU beds for every 100,000 people, compared with 11.4 in Singapore and 25.8 in the United States. In 2021, the central government set a target to increase the number, but so far it has only seen modest success. With this in mind, Chinese residents wouldn't be blamed for asking, why is it that billions was spent on testing and makeshift quarantine facilities this year, while relatively little has been spent on the resources needed for the eventual opening up? Currently, we are already seeing pressure on the healthcare system, and analysts are warning that, if in the next few weeks the situation is not managed well, large parts of the country may well see their hospitals completely overwhelmed and healthcare systems temporarily collapse. The next month or two could get very ugly indeed. Okay, that is today's episode of China Update. If you enjoyed the episode, don't forget to hit that like button. Thank you everybody for watching. I will see you all tomorrow.